What's making headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hi there and welcome back. It's Annie and Will joining you today for What's Making Headlines, our weekly wrap-up of the news and what's been happening here on The Advisor. I think we should pick up, firstly, Will, with the bombshell news that you dropped at the end of the podcast last week. You kept us under your hat. I said, what are you doing over the weekend? And you said, I'm getting married. I had no idea. How did it go?
Oh, it was awesome. Such a good day. Slightly surreal in the moment, but loved it. Yeah. Really, really good day.
Well, many congratulations to you for getting hitched now.
Yeah.
Very exciting seeing the Advisor team, expanding their life and getting out there and, getting hitched under the Harbour Bridge. And stunning place to do it. Ben obviously isn't joining us this week. He's off on his well-earned leave. So just you and I unpacking what's been happening in the news on The Advisor in the mortgage broking world. Let's start off, I think, with some of the big news that caught our focus this week, which was around the new ABS lending statistics that came out. Now, this showed a record for investor lending, which was massive over the September quarter. Will, I think you wrote the story for us for The Advisor. Basically, headlines, investor lending is going gangbusters. Over the quarter, it's gone up something like 14%. That's the number of new loans. The value, of course, also ticking up massively. What are we kind of seeing in the data?
Well, essentially, it was going up anyway, and then the last quarter, it's accelerated a lot. So as you said, the new investment loans, that was up 14%. So record dollar terms and number terms. And the previous record was back in 2022. And then if you look at new loans from investors year on year, that's up almost 19%. So
huge.
It's massively gone up.
Yeah. And so the value of new loan commitments also obviously having gone up as well, given that huge bump in the number of loans being written for investors. So something like 18% quarter on quarter. But also, if you look more broadly year on year, it's a similar sort of proportion, 18.7, because we had a sort of dip earlier in the year. It's ticked back up. Now, this isn't traditionally a major quarter for investor lending. We don't normally look at the September quarter for investor lending. Typically, the December quarter being, the home spring selling season, being the typical area where people buy houses, is where we expect to see a real tick up. So this caught a lot of people by surprise. Part of this reason, I think, maybe is because people are rushing to get in ahead of the home guarantee scheme expansion, which is now called the 5% deposit scheme. So everyone kind of knew the 1st of October was D-Day for open doors for 5% deposit scheme for first home buyers. So everyone, I think, kind of being like, we know there's going to be this massive ramp up in activity in October. So perhaps investors trying to get ahead of market there, being like, let's buy a property while we still can, because all of these FHBs are going to come into market in October. So seeing the number go up substantially, new records being set. It's around 40% of all new loans that were written in the September quarter were for investors, which I think is huge. I wonder as well, looking across the states, we've seen that kind of different types of states having different types of activity, as it's always the case. But even in the markets where properties are more expensive, like Sydney and increasingly Brisbane actually as well in Queensland, we're seeing a lot of activity across the board for investors. Maybe it's because some investors are trying to get into the cheaper markets before they really accelerate. So, looking over at WA and SA, those states doing fairly well. But then also just generally across the board being like, maybe I can't afford a property that I want to live in, so I'm going to buy and invest the property first. Huge amount of activity going on. I think lots of brokers that we've been sort of talking to have been like, of course, we've seen huge demand this year from investor lending, for investors looking to lend, whether that's in trust or not, which we've seen lots of movement in that space already from some of the lenders shifting. I think we spoke last week about Macquarie changing their appetites for company and trust lending. But lots and lots of movement here, not just in investor lending, also for first home buyers too.
Yeah. So also an uptick in first home buyers. As you said, they changed the rules in start of October. So we haven't got the full quarter yet. But you'd expect I think looking at the forecast for the December quarter, there's supposed to be a big acceleration in. So there was a slight increase, but they're expecting it to go up a lot.
Yeah.
And I think next year will probably be the same.
And
although I doubt it'll keep up with the investor
with the investor pacing. Well, I think also the other thing we have to bear in mind is that what rates were doing over this period as well, because between September 24 and September 25, we've had 3 rate cuts.
Yeah.
So 75 basis points of rate reductions, which will also obviously be bringing in more people looking into market, more people getting excited. But yeah, just specifically for that September quarter, I was stunned by that figure that came out from the ABS this week. That's almost 60,000 new investment loans over that quarter alone, which, as we say, is about a 14% increase compared to just the June quarter. So huge changes. And Mish Tan, who is the head of economics for the ABS, was sort of basically saying, there's really been growth in investment loans across the states, 19% in New South Wales, 18.5% in Victoria, 11.9% in Queensland, so basically 12% in Queensland, 10% in WA, 7% in SA, 28% in the ACT. Yeah. Now, maybe this is because the Parliament is back. They're sitting again. All the politicians are thinking about buying property, but that is whopping for crazy. ACT. Lots of people buying investment properties, but also maybe people thinking it's not that far away from New South Wales. Maybe I'll commute in now. So huge uptick there. Also, as we said, generally owner-occupied loans also going up a lot. So this, I think, feeding into mortgage fever at the moment, coming up into spring, and then also for this particular time that we're in the moment where we have lots of first-time buyers in market. We have rates are being super competitive. We know the banks are being super competitive as well and trying to get more business through the doors. Lots of them tweaking their offerings, coming out with new launches, the non-banks as well, expanding what they're doing. So I think 2025 going to be a massive year for the mortgage and property market. And if you cast your mind back, at the beginning of this year, people were suggesting maybe a 6% increase in house prices. We've already achieved that. There were some new figures from Cotality this week as well, saying we're now over $12 trillion in property values in Australia, which is a new record high. First time we've passed that milestone. And that was also achieved in September, I think. So kind of being like, well, look at what we've already seen in market. And that is without further rate cuts coming down the line. So if you, again, think about when people were forecasting the 6% rise in house prices, that was when we were expecting more rate cuts than we've actually had. So going to be a big year for property. And I think brokers probably listening to this will be like, yeah, it's been crazy. The end of the year, always a bit of a mad rush as people get into the spring selling season, as they get prepared for Christmas as well. And there's some holidays being like, let's get into market before that lull in January. So lots and lots to keep people busy. I mentioned generally as well, rates, what's been happening there. We've had fewer rates potentially than we were expecting. We did unpack the rate decision last week, but I think this new data on lending really feeds into a couple of other things we're seeing from the economic figures, including yesterday, we had the unemployment figures from the ABS come out, which showed that dropped as well. So more people in employment. Again, it's not something necessarily that I think a lot of people were forecasting. They thought maybe it would hold steady, but it actually dropped again. So more people in employment, more people in full-time employment as well. And that all goes to the whole thing, I think, around of are people under stress? We know people now have a job. I think it's about 4.3% the unemployment rate, which is still pretty low. Lots of people in employment, lots of people taking out a mortgage, as we can see from that ABS statistics that came out this week. Lots of people wanting to take advantage of the 5% deposit scheme, the incoming Help to Buy scheme, if and when that ever launches. Seeing lots of people interested in that as well, shared equity scheme. So plus spending going up as well. And I think this was a story you wrote from Equifax data, looking at personal loan applications have gone up a lot, credit card applications have gone up a lot, mortgage applications obviously had gone up a lot. So people looking to spend as well. So I think all of that combined, high unemployment, high spending, high borrowing, I don't know, this really, I think, adds to the argument of maybe we won't see any more rate cuts this cycle.
Yeah, I would say, yeah, that's all true, particularly with the employment data, because that was creeping up. And, the drop definitely adds weight to the point not to cut rates. The big outlier would be inflation, if that keeps accelerating. But then forecasts now are that, in theory, the Q3 could have been a bit of an outlier.
And again, we have to look at what is driving inflation, because if it's that people are just buying loads, then it's still like, well, maybe we're not actually in restrictive territory, which the RBA seems to think we are.
Yeah.
But if people are still spending and that's what's driving price increases, then
Yeah. I definitely think, I mean, if you look at the forecast, I haven't seen anyone say we'll get another rate cut before about
May.
Yeah.
And even then, I
certainly.
think some of the banks now kind of being like, oh, if
Yeah.
then, like really, let's have a look at what the next quarterly CPI figures are doing, and before that, the monthly figures.
Yeah.
Just to keep an eye on inflation and see if this is the end.
Yeah.
Which I'd be pretty bummed about, because I'd love a little Christmas present in the form of a cheaper mortgage. We've got one more rate decision to come, which will be next month. So we'll have to wait and see, but doesn't look promising for me.
Not next month, no.
We'll take a quick break here, but when we come back, I'd like to talk about some of the things we've seen from the banks this week. Financial reporting season continues. We've been looking at new trading updates and what they've been saying and showing us in the data, and we'll get into that just after this message. So last week, we talked a lot about the proprietary shift that the big four banks have been really focusing on. We've had new financial trading updates from a few lenders, including this week CBA. Again, no surprises here. Mortgage book went up, broker market share went down yet again. What was the overview from the trading update that we saw from CBA?
Essentially more of the same. So it's first quarter results. Home loans were 9.3 billion, so that's 1.1 times the system average for the banking sector. Home lending volumes up 6.1%. The big talking point, I say, was proprietary home loans were 68% of all new mortgage flows.
Massive.
Yeah, so that's obviously the highest of the big four, a new record for them. That's up 1 percentage point just over the 3 months.
Yeah, that's huge.
Yeah, really big. And that kind of shows how much they're focusing on it. And we know CBA is Australia's largest lender. They've got the most amount of borrowers. So really having that push into proprietary is going to do a lot for them. Like they've been eyeing, higher margins. We've had a lot of people being like, what does that actually mean? Like, show us the economics of what is an actual margin on a proprietary loan compared to a broker loan. Because some people are questioning whether they're actually comparing like for like. You might get the argument that a broker client probably has a bit more complex needs. They might be self-employed. They might have multiple properties. They might be a sophisticated investor. So their rates might not be the same as a vanilla PAYG borrower going direct to the bank. So they're kind of being like, show us the figures. We want to see what the actual economics of this are. But according to CBA, broker loans are, I think, about a third less value in them than proprietary. Now, again, we haven't seen the breakdown of that, so I'd be curious to see it. But that's really interesting. But I think the flip side of that is we saw figures from ANZ come out, complete opposite. Brokers pretty much still driving the majority of loans at ANZ. Yeah, I haven't got the figures to hand, but essentially, obviously, they've also got a proprietary focus. They started probably a bit later than CommBank. But yeah, essentially the opposite's happened, that broker flows have actually gone up in terms of a share of all lending.
So excluding Suncorp Bank, they are the same as CBA's proprietary. So 68% of new ANZ mortgages over the year were from broker, and that is the highest they've ever had.
Yeah, which is really surprising.
Well, I mean, kind of surprising, but also not. I mean, if you think of broker market share being at record highs, it makes sense for them, and they have traditionally, ANZ, been really super focused on broker.
Yeah.
But this is why recently they announced their push into proprietary, because they want to even out, I think, some of the flows, have a bit more control over where their home lendings come from. Again, a bit more control over margin. We know there's a new CEO there, Nuno Matos, who's had like a whole kind of strategization for the bank. So ANZ 2030 is their new plan under Nuno Matos, and he's really been like, proprietary is a big focus for them. He has said, though, of course, it's not about having one channel over the other. I think you had some quotes from him recently talking about this, because we were sort of asking, well, if you are pushing into proprietary, what does that mean for broker? Does that mean you're pulling back from broker? And they basically said, we want to grow both. We just want to kind of maybe even out a bit more, so that proprietary is also growing really strongly, because it's kind of been going backwards. And I think this is why, again, we're seeing so many brokers looking very closely at what the majors are doing, and lots of brokers also looking outside the majors and being like, well, who else is offering something that's really competitive? Who else is doing stuff that's really fast? And that also, of course, works in the best interest of my client, because at the end of the day, it's all about making sure their clients are well looked after and have got a loan that works for them. I think those are kind of some of the big ones in banking. But aside from that, we've also seen some commentary from the broker associations around what the big banks have been doing. And on Monday, we started the week with a big story from the MFAA. So Anya Panik, the MFAA CEO, really talking about channel conflict. Now, this is where it's not necessarily saying, we want both channels to grow well. It's where there's practices that have been kind of a little bit shady, maybe some anti-competitive behaviors as well. And she was really kind of pointing out that there's been more instances from MFAA members talking about under-the-counter branch pricing. So kind of saying, well, a broker will have a client, they'll want to get a really good rate, they'll ask the bank to reprice, they'll get a rate, and then at the point of discharge, the bank will call the client directly and be like, actually, did you know if you come into branch, we can get you a better rate that we can't give your broker? So this discretionary pricing really coming into being an issue here. But worse than that, I think it's when it actually gets declined. So a lender will say, no, we can't give this client a better price, or no, we can't give this client a loan, but then they will write that loan in branch. And that is something we hear a lot anecdotally from brokers saying, why is it even possible that a credit policy can change depending on the channel? Because surely if it doesn't service a broker, it shouldn't service in branch either. But that doesn't seem to be the case. So in the open letter that Anya was saying, she says, and I quote, "It remains unclear to me how lenders could deliver the personal connection and guidance that thousands of small broking businesses provide every day." She continued later, "Without brokers, Australian borrowers would be worse off with fewer choices and more expensive mortgages. That's an outcome no government, regulator or consumer advocate would welcome." She then goes on to talk about the fact that obviously brokers are helping push down prices by providing that competitive element, and really said that a home loan isn't a sort of cookie cutter add to basket transaction. It requires a lot of hand-holding and help and really explaining and making sure that clients are well-versed and well-informed on what they're doing. So she concluded, "Allowing channel conflict to persist undermines the trust and respect we should always have for one another. It wastes effort. It perversely destroys lender margin, especially when price undercutting and cashbacks come into play, and often results in a very poor customer experience." So really great to see Annie Panik coming out there, pushing back against some of this sort of behavior that's been going on, hoping to really eradicate it and saying, look, we're not going to be undermined by this sort of short-term corporate strategies. Australians need to have choice. They need to make sure they understand what they're doing, and brokers are the best place to do that. So yeah, really some punchy words from Anya there, and great to see that open letter. You can read the full open letter on The Advisor if you want to go check it out. And I think this goes as well to what we've been seeing in broker numbers as well. The FBAA released some research this week saying that broker numbers hit over 22,000 brokers, which is another record high. Similar figures we've been seeing from the MFAA as well. So really talking about the fact that more people are becoming brokers, there's higher broker to customer density now, more people actually able to find a broker if they want one, and really like looking at the proposition that the broker channel provides borrowers is something that is super exciting. The other thing that we did note in the FBAA, they also identified areas which are underpopulated with brokers. So if you're thinking about becoming a broker, maybe check that out and be like, where exactly should I set up shop? Where do they need more broking help? Because there were some figures there that were sort of talking about the low areas of broker density and some surprising ones, even in the capitals. We're going to take a quick break here. When we come back, we'll be looking at what else we've been writing out here on The Advisor, and we'll get into that just after this. Aside from all of the stuff that's been happening in broker world, we've also been looking at what's been happening in lender world, and there were some stats that I think I was probably the only person who actually read these. It's from ASIC, and it's about the number of new credit licenses and financial service licenses they issue. So each year they issue a report being like, it's how many people we accredited, gave a license to in the year. And what I thought was pretty interesting was that actually the number of new credit licenses issued has dropped to an all-time low. So we've only had the credit licensing regime in Australia for about 15 years. It came in 2010. I think it was mandatory in 2011. And this means like for lenders, for some brokers, if they want to be doing more sort of direct lending type things, they need to have a credit license. And over the financial year 2025, just 104 new credit licenses were granted, which is almost half what it was before the Royal Commission. So I was having a little play around the numbers and being like, what is driving this? Part of it might be that we just have fewer new entrants coming into market from a lending perspective. People who've been listening to this podcast for a while will know that kind of around 2018, 2019, 2020, we had a whole swathe of new banks launching. There was a sort of restricted ADI scheme they could go through. So we saw lots of applications for credit licenses around that time. Since then, we've either seen lots of those neobanks close or be bought by other banks, so subsumed into others. We've also had lots of mergers and acquisitions. So the mutual banking space, we've seen lots of mergers, which will result in existing ACL numbers dropping. This is for new ones. So I was like, well, I wonder why we have fewer people wanting to get a credit license, fewer lenders. Maybe it's getting too hard. Maybe the regulations are too high. Maybe it's too expensive. Maybe the dominance of the existing lenders is just too hard to compete with. I just think that's an interesting figure. So I wrote a story for The Advisor on it. And I just think it'd be really interesting to hear from listeners being like, why do you think fewer people want a credit license? Because this isn't credit rep numbers. It's not about broker numbers. It's specifically around the kind of the lenders, the supers, the bigger brokerages who have their own kind of funding line, insurance providers, people who are kind of really providing credit. But I just thought that was an interesting number, seeing the drop in new applications, and actually that there's only 4,466 active credit licenses in Australia, which I also thought was quite small.
Yeah.
ASIC had its big annual forum this week as well, so we have been seeing some more commentary from them this week, although that's mostly been on our sister titles that cover super and accounting, because it's really kind of looking at those areas. But I'm sure there'll be lots more to come from ASIC. We do know as well, we've had some regulatory updates from them on what their enforcement priorities will be for next year. One of them continuing to be private credit, which they've been talking about a lot this year. But aside from that, in the credit space, very little from ASIC for FY26. And then I think the other things that we've been sort of seeing in our news has been around lots of new product launches in the last few weeks. I think this always comes in the spring selling season, seeing lots of new products. But again, lots of people kind of bringing out changes. So Ubank had a new product launch this week, which was a 90% mortgage. Tell us a bit about that. I think you talked about to George for that story.
Yes. So targeting, I guess, kind of the target market would be first-time buyers with a deposit gap. So it was 15% deposit. It's now dropped to 10%. And
without having to pay LMI.
Sorry, no LMI. Up to 2 million, I think it was.
Yeah, up to 2 million for 90% LVR, which is pretty big.
Yeah. Well, I think they said the demand's there. They want to get more first-time buyers into homes. And they didn't rule out changes next year. They didn't explicitly say they would, but I thought it was interesting looking at demand, what will happen next year as well.
Do you mean in terms of new products or changing
or expanding, tweaking products or launching new ones?
And I think this again goes to the whole sort of demand we've seen, and the reason why the government launched the 5% deposit scheme has been around, well, can younger borrowers actually get into market because they're having to spend so long saving? So if they can access something that requires them to have a lower deposit, so a 10% deposit in this case, and not have to pay LMI, that will get them into market sooner. It will help them on their property journey sooner, and hopefully keep them ahead of the curve, because property prices, as we said at the beginning of this podcast, continue to accelerate. Just looking at the Ubank new products, so they said that borrowers with around $60,000 and a PAYG income of $125,000 may be able to purchase a property worth up to $450,000, which I thought was pretty good. Pretty good. And of course, we expect to see much more sort of product innovation coming up the next few months. Again, the run up to Christmas, we always have busy season from the lenders, trying to get that kind of really spring buying appetite and making the most out of that. So I think seeing some great innovation from Ubank then, it was great to hear from George Zebanowski talking about how brokers can really help provide this new option and also accelerate their approvals, because they now have a pretty quick end-to-end settlement process as well at Ubank. And we did note, I think last week in the NAB figures, seeing that big rise in Ubank loans as well. So really great to see that kind of investment in the broker channel from Ubank, and of course from other lenders too. Will, this is your final What's Making Headlines podcast with us. You're off to pastures green now that you're married. A new man, new job. So thank you so much for all of your help here on The Advisor and sharing and breaking news for our readers. And we wish you the best of luck.
Thanks very much. Yeah, thanks for having me. I'll still be following the podcast.
Yeah.
But yeah, wishing you the best.
Thank you. If you've got any questions for me or for Will, then do feel free to reach out. You can reach me at editor@theadvisor.com.au. Of course, check out all the previous podcasts on the Advisor Podcast Network and all the news on theadvisor.com.au. We hope you have a fab weekend, and we'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.